Hey guys, welcome back to the channel. In this video, I want to share some of Nick Sleep's most important lessons for investing in a market crash, and how we should be thinking about the current state of the market. As always, if you enjoyed the video, please hit the like button as it really helps the channel grow. So let's get into it. I thought Nick Sleep might be a good investor to get advice from regarding market crashes, because throughout his 12-year journey, Nick experienced two monster crashes. His first major crash was after the dot-com bubble in 2001, and the second was of course the global financial crisis in 2008. Something that's really interesting is that Nick had a different investing style for each market crash he went through. So no matter what investing strategy you use, you'll be able to take something away from Nick's experience in market crashes. When Nick and Zach started their fund in September 2001, the dot-com crash was already well underway, and it was pretty much perfect timing by the lads for catching the very bottom of the fall. As I mentioned in my other Nick Sleep video, earlier in his career, Nick was more of a Ben Graham style value investor who bought 50-cent dollars. And this strategy served him really well during this period. In a recent interview, Mohnish Pabrai pointed out that when the bubble began to pop in 2001, it was pretty easy to do well as a Graham-style investor because there was bargains everywhere.
And it was clear to me in late 99, even mid 99, that it was a bubble likely to pop. I had no idea when or how it would pop, but it was likely to pop. I did not want to expose myself to that. So at that point, about 99 or so, I made a switch where I went back to Graham type of investing. And what was happening in the US markets at that time was that very basic but good businesses were undervalued, whereas these hyped up businesses were, kind of pets.com, Chemdex, and so on, were at, stratospheric values. And so the day, for example, the day the NASDAQ peaked, I think like March 7th or March 9th, 2000, was the day that Berkshire hit a multi year low. So literally people were pulling money out of Berkshire and putting it into pets.com. And so I, at that point, was investing heavily into very basic businesses, funeral homes, and such. And that worked very well.
So despite the fact that the overall market was crashing, and there was a lot of businesses that were egregiously overvalued, there was still plenty of 50-cent dollars there for Graham-style investors to scoop up for a massive discount. Like Mohnish, Nick also did very well during the dot-com period, and from 01 to 03, their partnership compounded by 35% annually. Nick seemed to view the dot-com crash as a bit of a lucky break, because they had just started the partnership and had a big pile of cash to invest. And Nick said they were able to invest a sizable portion of the fund much faster than they would have anticipated, and at great prices too. This was probably a big part of why Nomad's returns were so good in their early years. If you're buying stocks and you have a load of cash to deploy, one of the best things that can happen is a broad market crash because it presents amazing buying opportunities for long-term investors. And that's exactly what happened to Nick and Zach. And for those with a long time horizon, they think it's a good time to be making investments. Nick wrote that during the late summer and autumn of 2002, when investors were at their most depressed, they made several new investments, and in some cases added to existing holdings. During the crash itself, Nick wrote about the need for patience, and he says that only by looking further out than the crowd can we beat them. This is something Nick mentions many times throughout his letters, and how having patience and a long-term outlook are two of the most important qualities to have during market crashes if you want to be a successful investor. Focusing on the short-term headlines or the macro environment is just a waste of time according to Buffett, and it may blur your vision to the facts that are truly important. You could say that it was pretty easy for Nick to be positive during the dot-com crash because he didn't really experience a huge decline and his fund did really well during that time. By sticking to Graham-style value investing, he avoided most of the calamity in the market. But 2008 was a completely different story. At the time, Nick had mostly transitioned to more of a Charlie Munger-style investor, and he had a pretty concentrated portfolio of compounders like Amazon, Costco, and Berkshire Hathaway. And when the global financial crisis happened in 2008, it wiped out Nomad's last 5 years of gains with a huge 45% decline. If we're analysing other investors to see how we should handle ourselves during crashes, I think Nick Sleep in 08 is one of the best examples we can learn from, especially if, like myself, you use the same investment style as Nick and Charlie, or you've had a big drawdown in your own portfolio recently. It's almost a given when using this Charlie Munger style of investing that your portfolio is extremely volatile in the short term, because you're concentrated in such a small number of businesses. And this is why Nick and Charlie put so much emphasis on the quality and durability of their companies, because a great business can weather any economic storm. And if you have a very long time horizon, you can almost ignore all the short-term market crashes unless you want to buy more. Nick wrote in a letter that their peers are trading shares at the short end of the equity yield where the competition is the greatest. In other words, they're trading shares in the short term. And we are investing at the long end, where the competition is least, or investing for the long term. We respond to completely different stimuli. Nick doesn't respond to market crashes the way most people do. Even though his portfolio had crashed by 45%, he said him and Zach experience almost no stress from investing. And he does this by focusing on the inputs to investing rather than the outputs. Nick wrote in 2008 that there are times when it's easy to feel good about investing, and there are times when it's much harder. The emotions usually go with the outputs. After Nomad's share price tripled, it was easy to feel God was in heaven. But as prices decline, spirits sag. We would counsel you to think about the inputs to investing rather than the outputs. It's in times like these that the hard psychological and analytical work is done, and the partnership is filled with future capital gains. This is our input, and the output will come in time. Those with a rational mind may not find it hard to feel good today, which essentially means that if you're like him, and you're looking further out than everybody else, then it's not hard to feel good, as there's a lot of buying opportunities during the bad times. Nick said many times throughout the global financial crisis that it does indeed feel different when performance has been as bad as it was in 2008. But even though it may not feel like it, these are the best of times for an investor. And in a later letter, once stocks had returned to pre-crash levels, he paraphrased himself again and added that great businesses were on sale and were, in our opinion, the investment opportunity of the crisis period. Most investors know that it's better to buy low or to buy stocks during market crashes, but a lot of investors struggle to know exactly when to get in and to make an investment. And honestly, the timing isn't as important as you might think. If you like a business at $1 and you think its intrinsic value is $1, if the business is selling for 60 cents and it's a great business, just buy it. If it goes even lower down to 50 cents, cool, just buy more. And if it goes back up to 90 cents, maybe just hold off and see if Mr. Market offers you a better deal another day. I really want to talk about one of the businesses in my portfolio, but I don't want to get in trouble, so I'll just say this. One of my largest holdings, just in the last year, has gone from being up 100% to down like 2 or 3%. And that wasn't from averaging up or buying at all-time highs or anything. Now, to some investors, this would be really upsetting, but I had a completely different philosophy on it thanks to Nick and Charlie's advice. It's funny because when this particular stock was at like 150 or 160, I remember thinking, shit, I wish I bought more when I first invested, because I didn't realise how great the business was at the time. So when the current crash started happening and the stock got hammered to below my initial buy price, I didn't have to think twice about it and I instantly doubled my position without increasing my average buy price. As Nick Sleep would say, these are my inputs and hopefully the outputs will come in time. Again, the key to pulling this off is you have to be patient.
The boy has no patience.
You will learn patience.
Like with this particular stock, I had to resist the urge to buy shares at 120, 110, 100, 90, and so on until it fell into the 80s. I do like the stock at 100 or even 110, but I also knew that the market could take a dive at any time. And I was patient enough to wait for Mr. Market to offer me a ridiculous price. The point is, the psychological side of investing is just as important as the analytical side, and in a lot of cases it's even more critical. And the choices made by investors during bad times really dictates their long-term performance. The final topic I want to cover today is how subconscious tendencies in the brain can affect our decision making, especially during market crashes and recessions. Nick wrote that psychologists have found that the brain perceives short-term rewards differently to long-term rewards because two different parts of the brain are being used. He says, immediate gains are perceived positively compared to even larger deferred gains because the limbic system of the brain, or the survival system, has the ability to override the frontoparietal system, or the analytical system. Interestingly, stress induces this override, and of course money induces stress. So he concludes, the more stressed we are, the more we value short-term outcomes. And all of this happens completely unconsciously. He breaks it down by saying, if you were starving on a desert island, one meal today sounds much better than the promise of a feast in a week's time. And again, this is the survival system overriding the analytical system. He says at Nomad, they try to be more analytical. I found this to be so true, and it explains the behaviour of Wall Street investors so accurately. And I've had my own experience with this phenomenon that some of you might relate to. There's been a few times I've bought a stock, and the very next day the stock goes up by like 5% or something, and my reaction is, this is my limbic system overriding my analytical system. because in reality, when I buy stocks, I initially want the stock to go down so I can buy more. And I find it funny that you can be aware of this, and your brain will still prioritize short-term outcomes over long-term outcomes. Nick says, the reason that there are so many opportunities during crashes and nobody takes them is because every headline, news channel and politician bombard us with so many economic predictions and forecasts that it affects our analytical thinking. He says crises such as these do not reveal mankind at its best, and he jokes that it causes far too much limbic thinking among investors. I think it's amazing that Nick could lose 45% of his fund in a year and come out with a brilliant piece like this. Losing your own money is bad enough, but losing that amount of other people's money would have been incredibly stressful. And many of the decisions Nick and Zach made during this period set themselves up for an insane run over the next 5 years. Decisions like concentrating more of the fund in Amazon and buying more when the price fell dramatically. Nick mentions this chart, where the black lines represent Amazon's revenue and the red line represents the share price. We can see the price has been pretty volatile over this time period, bouncing from over $100 down to under $40 and then back up to $80 again, whereas the revenue has been in a straight upward trend the entire time. I'm sure you can guess what Nick's reaction was when this crash happened. And that decision alone was probably one of the biggest drivers of Nomad's returns up until the fund closed in 2013. So overall, we can learn so much from Nick's experience in market crashes. During his first market crash after the dot-com bubble, Nick navigated the crash by only buying dollars for 50 cents and by following a Graham-style investment strategy. And during his second market crash in 2008, which made Nomad's portfolio half in value, Nick navigated it first by thinking rationally with the analytical side of his brain. And he realised that concentrating his portfolio into compounders like Amazon, Costco and Berkshire would be the best move for his portfolio over the long term, especially because they were all dirt cheap after the crash. And both times in the years following a market crash, Nomad's portfolio came back with a vengeance. I think the common denominator in both cases is that it's more about the psychological side than what investing strategy you follow, and that both strategies can work really well if you're a disciplined investor. So that's my biggest takeaway from Nick Sleep's experience in market crashes. If you enjoyed the video, please hit the like button as it really helps the channel grow. And if you want to see more videos like this one, be sure to hit that subscribe button. If you've watched the video all the way to the end, thank you so much for watching. And if you're still bored, I'll put another video up in the corner that I think you'll find interesting. And as always, this video is not financial advice and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for this video. Thank you so much for watching and I'll see you guys in the next one.